Ireland has the corporate tax rate of, I think, 12%. Until Apple brings that money into US, they're not going to pay federal taxes. You can't get out of tax in most states, so they're probably paying most of it is state tax. Of course they do. Again, money is fungible. You know, you can basically borrow money from somewhere else, lend that money to the company in Ireland, and the Irish company can pay your loan back. If I'm a bank, what do I care whether the Apple USA pays me or Apple Ireland pays me? A lot of big three, big four accounting firms, they have special divisions that are called transfer pricing. It's a fancy name for trying to figure out the optimal tax environment. I have a classmate from college. Uh, this guy got his PhD in economics from Princeton, and in our college days, he was a big time socialist and communist. Now he's a partner in Deloitte and Touche. He's making more than $1 million in base pay because he's the partner and he is in charge of the entire transfer pricing. So there is good money in that business. So, if you're into corporate tax and you're good at it, you can make real good money once you don't even have to become a CPA. This guy is not a CPA. You know, if you have a PhD from Princeton, nobody cares if you're a CPA or not. All right. Now, for our purposes, we're gonna kind of work with this formula, net income as sales minus cost. And when we say cost, it's not just cost of goods sold, all the costs except depreciation and interest. This is the basic formula we're going to use. Uh, if I give you sales, cost, depreciation, interest, and tax rate, it should not be a big problem for you to calculate the net income. Or suppose I ask for depreciation. If you solve this equation, you're going to get depreciation equals sales minus cost minus interest minus net income divided by 1 minus tax rate. And if I ask you for costs, of course, cost and depreciation will switch places, so on and so forth. You're probably going to say, where am I going to get the net income? There are two identities when it comes to net income. One is, where is the money coming from? It's the sources of net income definition. Alternatively, net income is equal to cash dividends plus change in you're probably thinking, what is that D? Now I'm going to convert that to Greek letters. That's capital delta. It's universal sign for change. This is uses of net income. So if your company made, I mean, let's look at uh, Apple. Where is their net income? Net income to common shareholders, they made $102 billion last year. Okay, this is after they pay taxes. Of that, how much they distributed, you can find the dividends under the statements of cash flow. You're not going to need it for this class, but for your own analysis purposes, they paid $15 billion in dividends. Okay, that means they added about $87 billion to their retained earnings. And if you made 102 billion, you distributed 15. Whatever you did not distribute, you basically kept it in the firm. That's the addition to retained earnings. So in this case, if I ask you, for example, how to calculate depreciation, if I didn't give you both cash dividends and change in retained earnings, that problem cannot be solved. But we obviously are not going to do that. If I ask something like that in an exam and didn't give you one of these, you could be certain that the answer, the correct answer is going to be not enough information or none of these. I kind of do that. Sometimes I put not enough information, even though there is enough information, because those kinds of questions essentially test whether or not you know enough what you need. You may not know enough to solve the question. Sometimes that happens. That's okay. But at least, do you know enough what you need? And given my exam system, where in numerical questions you get 3 attempts, if you know one or two of the answers are definitely wrong, you're guaranteed to get it at least in the third attempt, because there are 5 choices, right? So not only I'm going to reward you knowing what's right, but sometimes you don't know what's right. That's okay. Knowing what's wrong is very valuable, right? By the way, I just realized that Vlad is here. Oh, I think, let me get this stuff to the correct place. All right. I mean, I always say, if you don't know that, if you know that you don't know, I can teach you. But if you don't know that you don't know, there's nothing I can do about it. So knowing that something is wrong is valuable. All right. Let's briefly talk about cash flow, then we'll do a few problems. The cash flow concept we're going to use is cash flow from assets, CFFA. This is sometimes known as free cash flow. Just like net income, you're going to have two definitions of that. One is, what am I doing with the free cash flow? So uses of free cash flow. Cash flow from assets is equal to sum of cash flow to shareholders, CFTS, plus cash flow to creditors. So my cash flow is $100 billion. I'm going to give some of that to the shareholders, and the rest is going to go to creditors. Cash flow to shareholders. I can return cash to my shareholders in two ways. One of them is obvious. I pay them dividends. For example, Apple paid them $15 billion in dividends, right? I specifically use the term cash dividends on purpose because sometimes you may hear stock dividend. Stock dividend is not a cash dividend. A stock is split, it's called a stock dividend. Or company tells you, I'm going to pay stock dividend for every one share you have. I'll give you two more shares. That doesn't change anything. It just changes unit of accounting. Minus net new equity, where net new equity is shares sold to shareholders minus repurchases of shares. Sometimes companies, in order to generate cash, they sell some shares to the public. In most cases, let's say a company has 1 million shares outstanding, but a lot of cases there's a number called authorized number of shares. If that's 2 million, they can sell another 1 million. Of course, that dilutes the existing shareholders, but it brings cash to the company.